everybody. This is Mike Banner for this week's episode of 62 Who Knew. And I want to thank everybody first because we just keep breaking our viewership records. We're going to go for over 20,000 this month. And when you consider we started, Anthony, 11 months ago, I think the first month we had 400 views.
Not even a year, yeah.
Yeah, not even a year. And next year we're going to be in the millions, in the absolute millions. And the crowd goes wild for that. And that's it. Today, I want to welcome a very special guest. All my guests are special, but when the person, not only do I work with this man, but has become a friend, a confidant, a teacher. I mean, I'm in business 43 years, and when I don't know what to do with my mortgage, I call John. So I'd like to welcome today, who's been coming back. He's been on the show before, Mr. John Russo, who's the Regional Sales Director of the East Coast at American Pacific Mortgage, one of the top 10 independent mortgage companies in the country. He leads a team of professionals across the Eastern Seaboard. Born in New Jersey and residing in Florida since 2011, John's deep passion for home ownership was inspired by watching his parents become the first in their family to achieve that dream. We're going to talk about that in a second. With 23 years of experience in the mortgage industry, he is licensed to originate loans in New Jersey, Florida, Puerto Rico, and of course, American Pacific Mortgage can originate loans in 49 states. We'll get to New York eventually. Throughout his career, John has helped with thousands of families secure home ownership, build generational wealth, which is what this show is all about, through real estate investment. He is committed to providing his clients with personalized service and empowering them to achieve financial freedom. His leadership and expertise have made him a trusted advisor on a national level in the mortgage industry. So welcome, my friend. Thank you for being back.
Mike, thank you so much for having me.
So we got a lot to discuss, but just for a minute, because it always amazes me, whether it's Tom Hegna, the number one authority on annuities in North America, or it could be one of our national long-term care insurance people. Every subject we bring on, gray divorce, life insurance, annuities, mortgages, the expert with 20 or 30 years experience always came to their industry through something personal, through something related to family. And that staggers me. So your parents were the first in your family to achieve home ownership.
That's true. And, going back in long time ago, but going back in that history, remembering what that experience was, moving from renting to owning a home, going out looking for a home with them. I think I was 11 years old. My younger brothers were obviously younger than me. So had four of us in tow, bouncing from house to house with our realtor. That experience really stood out to me. And then the fact that we were no longer living in someone else's home, right? Mm-hmm. That the first Christmas that we had in our home together when I was 11, that really stood out as one of the best memories, I think, of my life, right? Just seeing the pride, the happiness on my mother's face that morning when we all came down the stairs and, Santa had visited our home, not someone else's home. That struck a chord with me. I wasn't supposed to do this. I was supposed to be a teacher and stumbled into the financial industry and then jumped right for the product in the financial industry that I love the most.
Yeah, what an incredible story, what a warm story. And it is incredible. So many of the younger generation, I seem to be complaining a lot about the younger generation. A couple of our fans, I shouldn't say fans, maybe they're fans, but a couple of our people that watch the show all the time, viewers, said, you pick on the younger generation, you might want to watch that. But I am a little upset with the younger generation, but be that as it may, a lot of them have forgotten that the American dream is not to be rich, not to own a fancy car. Those are all fun things. The American dream is to own a home. That is, if they want to Google American dream, it's to own your own home. And what a great story. I appreciate you sharing it. We have a lot of things to discuss today in the mortgage world, but the one thing that's all over Facebook, YouTube, it doesn't, every station you listen to, the 50-year mortgage, it's coming. I don't know if it's really coming, but it looks like it's coming. And I'm going to give my opinion on it, and then I'm going to, listen to yours. I'm doing this so long, mortgages, 40 plus years. I remember when the 40-year mortgage came out. And a lot of people don't remember. It came out specifically because people in California couldn't afford homes. Real estate prices have gone so high that even families making nice money with good credit could not afford a home. So the 40-year mortgage brought the payment down, made it easier to qualify. I won't say it's spread throughout the country because I don't think that many of them were ever done. But now, of course, home ownership is out of a lot of families' reach in this country, thanks to inflation. It's not just California. Look at Florida, where we are, my God. So on one point, yes, a 50-year mortgage will bring your payment down and more people will qualify for more home. The other point is the amount of interest that you're going to be paying just becomes one of my favorite words, staggering. And even though people that are proponents of this, not opponents of this, will say, yeah, but your average mortgage only lasts 5.5 years. They're not going to be there that long. But I think they're going to be very surprised when they're there 5 years, 6 years, 7 years, whether they're selling or refining, that they paid off, I'm exaggerating, but only a little, 12 cents, of their they've been paying $2,500 a month for 5 years. What is that? 2,500 times 12 times 5, $150,000 in payments. And they paid off such a ridiculous amount of principal that they're going to go, what did I get myself into? So just like living longer, just like everything else in our lives, I think a 50-year mortgage is a double-edged sword. What do you say?
Yeah, I try to stay as apolitical as possible in conversations, right, with new concoctions like this that are coming out. It is not something I would sign up for personally, right? I was again trying to put myself in my client's shoes because it would be a staggering amount of interest. That, right, if you just look at an amortization table, we know that 99.9% of payment number one is interest, and that 0.1% goes to principal, and it starts, right, that spread changes with each payment, but not drastically. And so if we're, if a 6.5 interest rate on a 30-year fixed is what I would be qualified for today, maybe I'm getting 7.5, 7.75, 8% on this 50-year concoction, because obviously a bank is taking more risk by lending to me long term. Right. We saw this with the 40-year mortgage, and I've closed thousands of 30-year fixed mortgages, and I've closed 2 40-year mortgages in my entire career.
I've closed 1 in my 40-year career.
I beat you. So that element right there, right? Given that folks hold on to their homes for 5 to 7 years, I think I would be in shock if I bought something for $500,000 that after 5-7 years has appreciated to the level, or should have appreciated to a level of, let's just say, something modest, 560, 570. And okay, I'll obviously earn on my appreciation there when I sell, but I'm probably going to be shocked after 5 or 7 years that I still owe $495. So the days of using homeownership to create generational wealth, I think, would be at risk here. And instead, we would absolutely be creating, and we saw this in Japan when they rolled out, I think, the 100-year mortgage in the 1980s, generational debt, right? We'd pass on the house with the debt to the next generation, and they're probably passing it on to the following generation. It's giving them shelter. It's giving them a roof over their head, but it's holding them in debt for their entire life. So that doesn't feel so great to me. If it's an option out there and folks are interested in it, right? I think it's incumbent upon us to lay out the pros and the cons, show them math behind it all, and let them make their decision. So I won't, yay or nay it completely and totally, but just from a fiscal responsibility standpoint, I can't see why someone would, to save $300 a month. I don't think it makes sense to pay another $600,000 in interest.
For millions of Americans, the greatest asset they own is their home. Yet most of that equity sits locked away, unused. What if there was a way to unlock your home's value without debt, without interest, and without monthly payments? Introducing Chiefs, converting home equity into financial success. A revolutionary strategy that lets you turn a small piece of your home's equity into cash you can use today to protect your retirement tomorrow. Visit 62whoknew.com to learn how Chiefs can fund long-term care, annuities, life insurance, or lifestyle goals.
Are you turning 65? Well, if so, the most important decision in your life right now is to determine which Medicare plan you need to be on for your unique changes in life. Are you still working? You on your employer's plan? How about being a snowbird? If so, you need to speak to a Medicare consultant who can help you with your needs. I'm Diane Daniels, and I'm the CEO of Medicare Nation. Go to www.62whoknew.com and click on the Medicare Nation tab. I will give you a free consultation to make sure we find the right plan for your unique needs.
And of course, right behind this on all the feeds everywhere is coming soon, the 15-year car loan. And I remember looking at that going, that's got to be junk. But I researched it, and there are major installment lenders in this country considering 10 to 15-year car loans. Now, the 40 and 50-year mortgage, I do not think is a good idea, but it's palatable because you hopefully are going to have appreciation. You're not going to pay off as much, so you're hopefully not screwed as much. Right. There are very few cars on this planet that appreciate. And most of our clients are not buying those cars. My son just bought a car and financed it over 6 years. Okay, it made the payment livable. But I remember him saying to me, in the next year or two, I'm going to refinance the car to a lower rate. And I said, no, you're not, kiddo. You're buried in this car, probably for 3 or 4 years, because the first couple of 2-3 years of your payment is all interest. So you're stuck. I mean, it's a beautiful car, and I'm sure he's going to keep it for a few years. I think a 6-year car payment is ridiculous, but 10, 12, 15 years on a depreciating asset, what the hell is going on? And that's just absurd to me.
Yeah, every time we pull credit on a client as we're beginning the mortgage consultation process, I sort of cringe when I get to the top lines, knowing they're not homeowners right now, and I know I'm going to see a car note. Right. So I don't see this, when someone signs up for a $900 a month car note, and we're trying to get them into a $2,500 monthly mortgage payment, I think to myself, right, this car is a third of a house that you could be living in. It was maybe not the greatest decision at the moment, right? And given the terms that were available to them, they put no down payment, right? They needed a car. Yeah, it's funny, I've had conversations with clients that have said to me, well, if only that could be amortized out over 10 or 15 years. I'm like, boy, I think there's, right, and that's an emotional reaction, but I think also there is a fundamental challenge in our culture around financial literacy and right, applying logic to making these decisions. Not to be insulting to our public, right? But I think it's a statement that more needs to be done earlier in life to help folks get ready to make these decisions.
With all the staggering classes that are given in high school, and of course I was one of those kids in junior high school. We didn't up north. We didn't have middle school. We had junior high school. But I was one of those kids in junior high school and high school yelling, what the hell am I going to use trigonometry for? I want to know where in life somebody's going to ask me to solve for cosine, or tangent or sine. Please give me, I'll buy a calculator. And this was the 70s. We still could buy a calculator that did it. And I turned out to be right because I'm 67 years old and not one of my mortgage clients, long-term care clients, annuity clients has ever said to me, can you tell me what the opposite angles of the hypotenuse of a triangle are? I would probably say, yes, I can, because I do remember, but no one's ever asked me that. So, but yet they don't teach a kid to balance a checkbook. They don't teach a kid that, well, again, oh my God, Anthony, I'm picking on your generation again. They go and they look on their phone. They go, oh, look, I have money in my account. Let's go to Starbucks. They're not counting the stuff that didn't hit yet. And then, 8 hours later, they go, why did the bank charge me $34 for being overdrawn? Because you don't have enough money in the account for what you did today. But the account said I did. Did you count in what you spent in the last couple of days that hasn't hit? And you can tell I'm talking about my children. And they'll go, well, no. I go, do you even know what's in the bank? And it's all their friends. It's everybody. And I'm not talking kids. I'm talking adults in their 30s and 40s. It's all of their friends. I don't understand why it says I'm in negative numbers. And they call me because I'm the banker. Even my children's friends. Mike, can you explain why I'm negative $206? Forward you my statement. You don't have to forward me the statement. You spent more than you had, moron. These are good. These are young adults that I've known forever. It just staggers me. But the financial illiteracy of the country. We have to do a show just on financial literacy. But getting back on target, because I veered there, when I see that $900 car payment also It just staggers me. And I've had big car payments, but I've also made some good money. And it's, it didn't stop me for qualifying for a mortgage. And of course, I love that one segment of a Tom Hegna episode, who said if these people knew that $900 or $1,000 payment in their 20s or 30s, if they put that into an annuity for 30 years, they would have $1 million in their mid 60s. So enjoy driving your $1 million car. And that really hits home. I really think it does. But that is what they're going to do. So let's talk about rates, because rates are good. And, I'm still staggered to the point, there's a word in the Jewish world, kvelling. I don't know if you know the word. Kvelling is just, do you know the word, Anthony?
No.
All right, well, that's because I'm the only Jew in your life.
Teach us.
Teach us. John knows, and he's not Jewish. Kvelling means you're in heaven. You're like in your best surroundings. It would be like, putting me, in a restaurant that only serves bacon and chocolate. I mean, that I'd be kvelling, okay? The nation should be kvelling. Rates are in the low sixes, high fives. In fact, if you get a little help from the seller on closing costs, which I'm just going to say it, most realtors go, oh, the sellers aren't helping with closing costs. Bull. That was 2 years ago. Now they're helping. They want to sell their home. Houses are staying on the market 120 days. This isn't 2 years ago. When rates are in the mid to high fives, the country should be prospering. Yet the fear out there, the country is in a state of fear, and it shouldn't be. Rates are in the high fives, but it's not. Realtors are afraid. Mortgage people are afraid. You've got, it says 20, but I think you're closer to 30 years, aren't you? How many years of experience do you have?
25. Jumped in
25, okay.
Yeah.
Yeah. What the hell is going on here?
That's a loaded question, and we probably need 6 or 7 hours. So I start with real estate is local. I have friends in different markets throughout the country. Right, you and I sit in Florida, where I used to sit up in New Jersey. There's an inventory shortage. Virginia Beach, there's an inventory shortage, right? So market by market, we have inventory shortages. It's these two polar opposites that we're experiencing, right? We can never be in the middle. So where you have the shortages and then you have the overabundance, right? Down here in Florida, we have the overabundance issue right now that we're dealing with, which is pushing up days on market, which is making this an absolute buyer's market. I'll say to anyone in Central Florida who says sellers are not participating, just about every contract I've received this year has come with somewhere between 3 and 6% seller concession to help the buyer with their closing costs and buy down their rate, which has helped us put some people in rates in the low fives with those concessions. But every corner of the world has its issues. Ours is more so, I think, buyer reluctance and fear, because we really, really, really fell in love with those 2s and 3s and 4s that happened during COVID.
Yeah.
The muscle memory is there. No matter how many times we say it is probably not coming back unless something catastrophic happens. That was an anomaly. If you look at, the last 75 years of interest rates on the 30-year fixed, it was never, ever, ever anywhere in that zone. I mean, in fact, in 25 years, I think my average interest rate given to my clients probably is in the high 6s, low 7s. So we're in a better spot right now than where we were there at that time. In the other side of the world, where you have, the unfortunate lack of abundance in listing activity, you have folks holding on to that 2.25 interest rate. And even though
you can't blame them,
right? I'm going to give up this house that has a ton of equity, sell it, and have to go buy something else that I need a mortgage on that I'm going to have to pay 5 or 6% on. Mathematically, it doesn't make sense, even though circumstances might put them in a spot where they feel they should sell. They're not selling. The other issue is if folks move, they hold on to their property now and hold it, they retain it as an investment property if they move out of the home because it has a 2.375 interest rate. Right. So there's problems everywhere, but I don't know that we as an industry are winning in the space of communicating well to the first time home buyer or the repeat buyer that we are actually in a good place comparatively. Right.
Yes.
And I keep hearing from folks, I'll keep paying rent until, we get back to the 3s and 4s again. My fear is they're going to live the rest of their life paying rent, if that's the
That's right.
litmus test that they're holding themselves to.
Whether you're purchasing a new home or refinancing the one you love, one thing has never changed. Mortgages remain the most inexpensive cost of funds available. And in today's market, choosing the right mortgage professional can save you thousands and help secure your financial future. That's why the 62 Who Knew podcast partners with American Pacific Mortgage, one of the nation's most respected lenders, helping homeowners make smart decisions at every stage of life. Visit 62whoknew.com to learn how the right mortgage strategy can power your retirement plan. As we live longer than any generation before us, one question becomes more important than ever. Will your income last as long as you do? On the 62 Who Knew podcast, we dive deep into the strategies that protect your future. And at the center of every strong retirement plan is guaranteed income. Annuities create income you cannot outlive. They provide stability, protection, and peace of mind, no matter what the market does. Visit 62whoknew.com and start planning the rest of your life today. Yeah. And we have some unique issues in Florida. Property insurance is just staggering. I mean, it's just using that word too much again. Find me a synonym for staggering, please.
Astounding.
It's one of my favorite words. Yeah, it's astounding, but it is. So we have that unique. Now, hey, I don't want to curse us, but no hurricanes. So it's almost over, and now it's too cold for hurricanes. I mean, the temperature is actually a little too cold for hurricanes to form, but still, it's not like the national insurance companies are going to go, we didn't make many claims this year. Let's lower your premiums. I don't think they're going to do that. So we have some unique problems in Florida, but you're right. The mortgage industry has never been that good, ever. We sort of flow with the economy. I'm delivering a message. Yes, we'll say, we'll close your loan in 3 minutes. Yes, we'll do this, we'll do that. But we are in great times right now. I personally think inflation is higher than what we're being told. I've never understood, I think I say this almost on every show, inflation's at 3 or 4%, but things in Publix are 50% more expensive than they were 3 years ago. How do they figure that 3 or 4% to, a head of lettuce that was 60 cents is now $2? That's not 4%, that's 300%. So we have some unique issues going through the country, but it leads us up, really to another subject. Down payment assistance programs, which have always been frowned upon, I'm just going to say it, by the real estate community. I mean, realtors, who I love, that put my kids through college, every good thing I've had in life came from my realtor partners, and they're my favorite people. But they are creating, and I'm just going to say it, and Remax is one of our national sponsors. We'll discuss it with Chad next time he's on the show. There's a lot of realtors waiting for rates to come down. There's a lot of realtors going, people don't have a down payment, it's impossible. Well, when I started, the down payment assistance programs were all FHA related, all. And now you're really going to laugh, but in 1982, in Pinellas County, the FHA loan limit was $72,000. So yes, the people that couldn't even come up with 3.5% of $72,000, which is $2,400. Yes, they were buying cheap homes, maybe on not the best side of town, and the realtor really didn't want to take care of them. You probably know this better than me. What's today FHA's loan limit?
In the lowest cost counties, 524 and change.
Yeah, this is not a cheap home anymore.
No.
And I'm going to shamelessly plug American Pacific Mortgage. That's who you're with. That's where I'm with. How many down payment assistance programs do we have? Dozens?
Last time I counted, 3 dozen available to us in Florida, coming in all sizes, shapes, forms, with FHA, with conventional, with VA. Right. Then you've got USDA that doesn't need any down payment, so there's no assistance needed there. Right. Just tons of opportunity for, let's face it, right? Many first-time home buyers are cash poor because they're spending 300% more to buy a head of lettuce. They don't have the ability to save at the same level, but the payment on this home is going to be very similar to what they're paying in rent today. So this bridges the gap.
But it really does. But, and even if you take away the head of lettuce, your average family, my older daughter, I won't say her age or she'll kill me, 3 children, one of them in Little League, one of them in travel Little League, extra school activities. My son-in-law and daughter make good money, but is there a lot left over at the end of the month to save up a down payment? Now, knock wood, they're very smart, and they bought a home almost 8 years ago that is appreciated greatly, but they worked hard to come up with that 5% down. But if you're going to buy a house for $500,000 or $600,000, 5% is somewhere between 25 and 30 grand. You really would rather have 10% because, as we know, the PMI on 5% is unbelievable. But a family making good money with that 800 credit score, they've kept their car payments in line. A married couple with 2 or 3 children saving somewhere between $25,000 and $50,000. That's next to impossible in today's world. These down payment assistance programs, somehow we as mortgage people have to look at the real estate world and say, guys, open up your head and, quite frankly, open up your heart to these people paying $2,500 to $3,000 a month in rent. They qualify. They just don't have the down payment. Well, I don't know if my seller is going to afford it, is going to accept an offer. That's a self-fulfilled negative prophecy. Because if we have a DU approval or an LP approval for our audience, DU is desktop underwriting, LP is loan prospecting. That's for Fannie Mae and Freddie Mac. That is an absolute commitment for a loan. Don't get a pre-qualification letter, get a pre-approval from a great company like American Pacific Mortgage. It's as good as the person putting down 20%. Am I exaggerating here? Once we have an approval?
No. To protect the innocent, I'll change the name. But as we're talking through this, I'm thinking of a closing from last month, and we're going to call him Jim. Jim's a single dad, two young boys. One is severely autistic and is in a school, so he needed to be in a certain neighborhood. Average purchase price in this neighborhood is well above $600,000. So his realtor worked very hard to find him right in the sweet spot that we were looking in, 500 to 525, right around there. So we obviously pre-approved him. He and I had he's a smart guy. He's an engineer. We talked about how to approach the down payment. We were going with FHA, 3.5% down. That opens up an abundance of down payment assistance programs that we have available to us. And his counter argument was, I need 3.5%. We're going to, find a home where the seller will cover the closing costs and help me with a rate buy down. I'll pull the 3.5% out of my 401k. I can take a hardship withdrawal. And I said, Jim, you also have to retire at some point. You're 38. Is that right? Let's think of the impact of that. And what are you earning on your 401k right now? Well, blended return of about 15.5%. Don't take something that's earning 15.5% and risk it when we can find a way to fund this for you, and whether you pay it back, whether it's a grant, right? I mean, obviously there's a ton of different options here. Mathematically, again, and logically, we were able to show him this was the best possible way, and we had an abundance of options. He's actually made his first mortgage payment November 1st, and he was able to get into this house he put a $3,500 earnest deposit down on the house, and he received $3,100 back at closing. Mm-hmm. Right.
We've got to do a better job at delivering the message that these are viable programs. I hate to say it, they're not for the people on the wrong side of town, and I want to help all those people on the wrong side of town as well. Not every real estate agent or mortgage person does want to help the people on the wrong side of town. But when you can buy a $500,000 to $600,000 house, and we can help a man like this, a single dad, with the down payment, the real estate world shouldn't be running away from that. They should be running to it. Which brings us to another self-fulfilled prophecy, that I hear a lot, is that sellers have a problem when the pre-approval is an FHA or VA loan. Because the inspector, the appraiser, is going to be so much rougher. And that, well, again, apologizing to my real estate partners, brothers and sisters, that's another self-fulfilled prophecy that you created. Your seller never knew that, okay? And I'll give them some credit too. Before 2008, before the bubble burst, I'd have to agree that a conventional appraisal was a lot easier going on a home than an FHA appraisal. But since the bubble burst, and since every lender and bank in the country blamed the bad decisions they made on the appraisal, it was a bad appraisal. They shouldn't. It wasn't worth that much. They all blamed everybody but themselves. I have to say, I think a conventional appraisal lately, I'd say the last 10 years, is as strict almost as an FHA appraisal. That appraises in that house, and appraisers don't get enough credit sometimes. Sometimes we all beat up on them. They have to cover their ass. They're looking at the stain in the ceiling. They're looking at the soffit, which 20 years ago, appraisers didn't do that. Property inspectors did that. But now appraisers need to cover themselves. They don't want a hit on their E&O insurance because they said the house was worth $600,000 and it was really only $580,000. So again, to our realtor friends, I don't know if you're seeing that. I don't know if my client wants to take a pre-approval from a VA loan. He's not putting any money down. What? He's approved, and he's a veteran. And you're worried about presenting that offer? Are you running into this at all?
Yeah, in pockets. I've had to have some very shocking conversations with folks when I typically if one of my buyer's agents is making an offer on behalf of one of our clients, I will call the listing agent as they receive that offer to support what we're trying to do, right? So I'll fill them in, let them know who I am, what we've done already. We've underwritten identity, credit, income, assets, employment. I'm there to support it and let them know we're not going to have an embarrassing flop in the event that they accept this offer. Every once in a while, I'll hear something, right, like a snickering of, it's VA. How's this going to work? This is a neighborhood that sort of, it's a little cash richer. How's this person going to fit in here? I mean, like I'm literally hearing this conversation, which is overt discrimination. And saying, I didn't evaluate their ability to fit in a community. I evaluated their ability to pay this mortgage. And we've underwritten them already. And this is a veteran who we should be thanking for his or her service. Whether your seller accepts it or not is another story. So there's random weirdness that comes out of people's mouths every once in a while. And I'll just attribute it to, being novice in the business or not realizing what they're saying. But the bigger side of that, because I see less of that, I see more of we're not accepting this type of financing because
that's right.
The home needs a little bit of love in this space, that space, and that space. And we don't want this to fail as a result of the appraiser saying XYZ, right? So when we dig into that conversation, I'm like, so what is wrong with the house? I looked on Zillow. I looked at the pictures. I don't see anything that stands out to me. Of course, I'm not in it. Kitchen's a little dated. Lots of kitchens are dated. The appraiser is not an interior designer. The appraiser is coming out to test whether or not this home is safe and valued at what you're selling it for. So the other side, the flip of it is when we do receive an appraisal back and we have 19 punch list items, that property should not have been set up for FHA financing. There's chipped paint, there's broken outlets, there's electrical issues, all of which are very obvious to the appraiser's eye. So in that regard, it's how do we get to a place where we're open to what can work and we know what can work and we're closed off to the things that we know that absolutely can't work. Again, it seems like we live on the fringes and I'd love to find a way for us to meet somewhere in the middle on this. But at the end of the day, when these property issues do happen, right, and most times they don't, but when they do happen and the seller is unwilling to remedy, we have a buyer who is probably relying on down payment assistance, first-time home buyer who just pulled $600 out of their pocket for an inspection on a house that they're not buying anymore. And maybe, right, at this point, we now have an appraisal, so another $500. Now they're out $1,100 on something that they're not buying. And then it sours their perspective toward doing this. So I always believe there's a way to find complete transparency as we're beginning a transaction so that we get through it and we do the right thing by our client. But again, when we're dealing with these fringe issues, sometimes it's enough to make people step away.
And it's the two extremes. You mentioned the novice realtor or maybe even the novice mortgage person. Let's bring our own industry into this. But I think it's the two extremes. It's the novice and it's the dinosaurs who are still thinking that the market is the same as 30 years ago. And it's not. Yeah, I'm doing a little video that we're going to put out to tens and tens of thousands of realtors. We're doing it next week, through AP. Being a mortgage dinosaur, people started calling me that probably 3-4 years ago. And at first I was, okay, fine, I'm a dinosaur. Now I'm kind of embracing it because I am a dinosaur. And you're not as much as a dinosaur, but I know how you work.
Getting it.
I don't end my day until I return my last call. I answer my emails. If I am on the weekend sitting in the bleachers watching my grandson play a little league game and my phone rings and it's one of my real estate partners, I answer it because they're probably selling a house. It's Saturday at 3:00. There's a lot of generation, of mortgage people go, yeah, it's the weekend. It's my time. Can you believe somebody called me at 8:30 at night and wanted to be pre-approved for a mortgage? I go, can I believe it? It's the best thing in the world. It's what I live for. What's wrong with you? I don't know if you're running into that, but I see that a lot. I love the technology. I really do. We approve loans now if the application is complete, in 20 minutes, 30 minutes? 40 years ago, this took a long time to do when I started doing this, with my IBM Selectric typewriter. But it has hurt. It has created a couple of generations of realtors and mortgage people that want it now. And there's a lot of people in this world, a lot of families. You're a single dad with a son with special needs that need that extra work, that aren't going to get the pre-approval in 30 minutes. They need a dinosaur to sit down and talk to them.
Right.
And say, let's work through this. So I've become to, over the last year or so, become to relish in my dinosaur nickname. Yeah, I'm a dinosaur. I'm going to take care of my clients. I just am. And if that's 9:00 at night or 3:00 Saturday afternoon, or saying to them, what are you, crazy? You can't take money out of your 401k. Probably would have been an easier deal for you if he did that. Source the funds, no home ownership counseling, no down payment assistance program. Probably would have been easier. In fact, take 5% out. Let's go Fannie Mae rather than FHA. But you did right by him. And sometimes I think the technology, and let's face it, everybody thinks this, I'm not being unique, has taken away some of the personal part of helping people achieve the American dream. What's the biggest threat to your retirement savings? It's not the stock market. It's the cost of long-term care. Home care, assisted living, or nursing facilities can drain your life savings in just a few years. That's why long-term care insurance isn't a luxury, it's a necessity. It protects your assets, preserves your independence, and gives your family peace of mind. Don't leave your future to chance. Visit 62whoknew.com and start planning the retirement you deserve. Today, the average funeral can cost $10,000 to $20,000, and too often families are forced to make difficult decisions at the worst moment of their lives. Final expenses create stress, debt, and heartbreak, right when your loved ones need comfort, not crisis. That's why the 62 Who Knew podcast brings you trusted guidance on final expense insurance, an affordable, compassionate way to protect your family from unexpected financial burdens. Visit 62whoknew.com and learn how a small plan today can spare your family emotional and financial pain tomorrow.
I think one critical, just to sort of, again, out on the fringes, put two loan officers together in, two side-by-side offices. One individual says, I do 15-minute initial consultations with my clients. I stick to a calendar. I do 25 of them a day. And then you've got me sitting in the office. I try to schedule everything, as far apart as possible, because I know sometimes I'm going to get really deep with it. There are some conversations that could finish in 11 minutes. There are some that take 2 hours. And right, I would never dream of saying to somebody, well, it's 10:45, our time is up. I've got to jump into my next consultation. We could schedule the continuation of this conversation later about this default that isn't yours on your credit that I'm going to help you with. Bye now. Right. The level of care that we bring to our practice. And that's not a older, younger sort of thing. It's different approaches to the business, right? The person who sets that 15-minute, sort of hourglass to say, this is the end of it, is not really going deep with that family or that client, doesn't really know their needs, doesn't really understand who they are. You and I have talked about this, right? The element of our business that is repeat customer, because of the fact that we've developed a relationship as a trusted advisor
Absolutely.
17 years ago, brings them back, right? And I take great pride. I'll always tell my story of my favorite client. I love all my clients, but right, single mom out of a really bad marriage, divorce. This was a bunch of years ago. Came to me with damaged credit, was building a house, got the credit fixed up and all good to go by the time she closed. And she closed in 2014. And today in 2025, she owns 41 pieces of real estate, all financed with me. Right? Like that the what you put out there, you get back. So this over reliance on let's do quick, fast, easy AI, right? Like that's not going to create a repeat client relationship. And we do good in doing that in our industry. We help those around us also, right? Because they'll buy again with the same agent. They'll look to increase their portfolio with the same agent, or they'll sell with that agent again, because we're maintaining an ecosystem, right? We're keeping each other sticky, if you will. And I think that's one of the things that as I see newer folks coming to our business, I think that's one of the gaps. I just see let's go really, really fast, and they leave a lot on the table, and they don't really go deep.
Absolutely. And I want to bring up another subject that I think, the mortgage world as well as the consumer world is a little confused on. I'm doing more refis than usual the last few months. And people go, oh my God, I'm not going to refi. Rates are too high to refi. I don't blame people for wanting to keep that 2.5%, 3.5%, even 4% mortgage. I don't. But when I talk to someone, they go, oh God, and not everybody's at 2.5% and 3%. In fact, the majority of the world is about 3.5% to 4.5%, but still a lot better than where we were and just a little better than where we are now. And they're hesitating. What's the rate on your 4 credit cards that you owe $38,000 on? One's 18.5 and one's 22. And what's the rate on the car that we're going to get rid of that $800 payment that you have 18 payments left on? That was 12.5. Oh, okay. So you're telling me a couple of $100,000 that we're going to take, well, probably about $100,000 in that case, from the 18s and 20s down to the 5s? You're worried about that? But I'm losing my 4% mortgage payment. And again, this is where technology fails and a pad and paper succeeds. Okay, here's your mortgage payment now. Here's all your other payments. They equal X. If we get rid of your 4.5% mortgage, I'm so sorry, and we put you into 5 3/4, but we get rid of all the other things, and you promise not to do it again, because that's suicide. That's financial suicide. We're saving you $1,800 per month. Yeah, but that 4.5%, $1,800 a month. What is that per year? $21,600. Why are you so proud of that 4.5? Why are you so protective? You called me because you have no money at the end of the month. You have no money at the end of the month because you have $2,000 a month in credit card bills. And again, this whole mental thing. Oh my God, rates are too high. Not compared to most of your debts, they're not. In fact, they're a quarter. They're 25% of what most of your debts are. We just closed a loan in New Jersey, you and I, saving the, not saying the names like you said, to protect the innocent. And we took this man from a $50,000 mortgage at 4.5 that I did for him a few years ago to a $685,000 mortgage at 5 7/8. And I'm not exaggerating. We are saving him $3,400 per month. And, I was on the phone with him today, even though we closed 10 days ago. He called up on the way here. I can't believe, we're approaching the holidays. He doesn't have a payment in November because we closed him in October. So I have no payments this month, none. And in December, I'm going to have $3,400 a month more to buy toys for the kids and the grandkids. What a great mortgage. But you can't just look at it as the surface. You got to do math.
Yeah. And again, right, it's I don't want to sell and go buy another house because I have a 2.875 and I don't want a 5.75. It's endemic of the same right problem. It's we're just fixated on that number that I think probably did us in for the next decade or so.
Yes.
Right, we're all going to be swimming upstream on this one. But the reality is, right, and I'm kind of shocked at how many conversations I'm having, and I do think that I bring logic and care to my practice. So I literally just got a text message yesterday from a client who had a great consultation together last Friday, laid out everything. His is not even consolidation of debt. It's just he bought a short-term rental investment unit a year and a half ago. We financed it at a rate of 8%. I showed him how we could end up in the low sixes right now. And it wasn't enough. Right. I just like that part for me. It was like, we're sort of thinking, things are coming down. The Fed lowered rates 2 weeks ago. So maybe we're going to wait till we get to the 4s or 5s. I can't battle that other than to continue to have conversation and show you're paying this much on a monthly basis. You could be paying this much on a monthly basis. Let's look at the cost of refinancing. Yeah. So I do think the overarching theme is that muscle memory tied to, right, I had this thing at 2.375 and I'm not losing it. I'm not letting anybody take it from me. Yet you're paying $3,000 a month in credit card and installment loans and personal loans and home improvement loans and all these other items that at the end of the day, I don't care about the interest rate, right? I don't get paid on an interest rate. I get paid what I get paid on a monthly basis, and I disperse what I spend on a monthly basis. I care about cash flow, right? So coming down to the end of the month and having nothing left in the bank, waiting for a replenishment from a direct deposit to make the mortgage payment, and having nothing again until the next direct deposit comes in to pay the other bills and buy food and everything, pay the utilities, not the ideal way to live. And folks aren't using their most important asset the way they could be using it to consolidate that debt.
Which is always the least expensive money.
Exactly.
Throughout history, your house is, if you're going to borrow in your house, it's the least expensive money. And, before we sign off, I do want to go over a couple of things, because American Pacific Mortgage is a great company. We've talked about Fannie, conventional, fixed 30-year. We've talked about FHA. We do VA. There's so much more, and people don't realize it. To all our self-employed friends, to all our people, that are working in restaurants or doing nails that don't show all their income on their tax returns, you crafty little devils, you. But that's okay. That's why the tax laws are what they are. You're allowed to do what you do. We have 12 and 24-month bank statement loans for people that make good money, have good. How many times do you write a loan for someone? I'll pick an industry. The man that's doing your lawn that has 300 accounts, and he has 2 beautiful trucks, and he drives a beautiful car, and he has an 800 credit score. But his tax returns show he made $18,000 last year. But his bank statements show a lot more. These are great rate loans. Again, this is not 20 years ago where, you can't show us your tax returns. I mean, you and I are doing bank statement loans that are way into single digits, mid-single digits. So we're there, American Pacific Mortgage is there for the first-time home buyer. We always love our veterans. Bank statement loans. I know you do so many foreign national loans for people that are incredible. Tell us a little bit about that, because I know that's one of your specialties.
Absolutely. Yeah. And it's funny. I was just traveling abroad and trying to think of ways in which I could advertise that. What we do while I was in, Turkey and England a few weeks ago, I looked into purchasing a home in another country and my head almost popped off my body with how convoluted and complex the process would be. And I didn't pursue it. This was a bunch of years ago. And a lot of folks right out in other countries who visit the United States, want to have a vacation home or an investment property here, don't realize actually how absolutely easy it is to finance, right? So, you heard me say before, when I issue pre-approval, I speak to the listing agent, assuring them that everything is great as far as identity, credit, income, employment, assets. Well, identity, yes. We need to make sure that we have identification documents for the foreign national. Credit. There is no credit report in the United States. There is no credit, period. We're not looking at a credit report. Income and employment. we assume that they are they have an income and they are employed. It doesn't matter. Right. And there is a version of the foreign national loan where it does, and you could do that one. But most of what we do is cash flow lending. So what we're looking at is a foreign national putting 25% down. Let's make the numbers nice and easy, right? $400,000 purchase price, put 25% down. You have to show me you have $100,000 in your bank in your country. We currency convert it. And if you have that and you have identity documents, you could purchase this home. And you need either 6, depending upon the investor, 6 or 12 months of reserves for that monthly payment. The question that we're asking in this is, if your payment will be $2,300 a month, will it rent for more than or equal to $2,300 a month? That's the test in this type of loan. For me, it's a no-brainer. These are sometimes a lot easier than working with a first-time home buyer seeking down payment assistance, might be credit challenged. We, as an industry, don't do enough of these as well, right? There are tons of foreign nationals coming into our country buying with cash when they could be using that cash in different ways.
The DSCR loan, where we don't even ask if they have a job. We don't put a job down on the application. It's an investor loan. It's the true no income verification investor loan. I'll say it again. We don't even ask if they have a job. They need good credit. They need X amount down. We season it for 30 days instead of 60. When somebody says to me, oh, it's, and I hear this, not a lot, but I hear it. It's so hard to get a mortgage in this country. No, it's not. It really isn't. Now, if you have no money and bad credit, do we have anything like that yet? There we go. No money, bad credit. I feel like Johnny Carson at the Tea Time movies. The younger viewers are not going to remember that. No money, bad credit. Thank you. No money, great credit. We're putting you into a house probably. I didn't know we had that sound. Great credit and money. Oh, I'm going to adopt you. Besides, or I'm going to see if you can adopt me. But we just, it's not difficult to buy a house in this country. Things may be bad, we may be divided, but it's still the easiest country in the world to create home ownership. And it is what makes America America. I'm going to remind everybody before we say goodbye to go to www.62whoknew.com. Click on the AP Mortgage tab if you're interested in talking to anyone throughout the 49 states. Again, sorry to my New York brothers and sisters, but we're not there. About a possible consolidation. Does it make sense to sell your home and buy another one? Does it make sense to keep your home? My God, as a rental, what a retirement plan, and go somewhere else? The professionals at AP Mortgage, I would be happy to have that conversation with you, no matter where you are in the country. And if you are interested in listing your home or buying a new home, then as soon as we get done pre-approving you at AP Mortgage, you're going to go back to www.62whoknew.com. Click on that famous red, white balloon, and you're going to talk to one of the finest RE/MAX real estate agents anywhere you are in the 112 countries that RE/MAX does business. Yes, you can get those services through 62whoknew.com. You want to use the red and white balloon. They are voted 11 years in a row the most trusted real estate company in America. So we're trying to help you prepare for retirement here at 62 Who Knew with the finest mortgage situations, mortgage scenarios, and real estate scenarios, and long-term care insurance, and annuities. And, if John and I have to, we'll come over the weekend. We'll do the lawn if that's what you need, before the appraiser comes out. We'll put our tool belts on. We'll do what it takes. My friend, thank you for everything you do for your clients, for AP Mortgage. Thank you for everything you do for me. Working with me, because I'm not that easy to work with. You think the audience can know that? Yes. Okay, fine. Yeah, John, thank you so much for being here. And that's it. Of course, I'm not going to say have happy holidays, because we're going to see each other a million times before then. Thank you again for being here.
Thank you so much for having me, Mike.